feel the market when you hear people, like that. We got that kind of pop there, and it's literally right as we're pushing to kind of the highs of the multi-hour chart.
The interesting thing in my time on a floor was you could hear what the market was doing. That is, as volume increased, literally the volume on the floor would increase.
It's Scott Asian's volume too.
And I did pretty well when it comes to presence in the pit. So that was actually something really interesting that you could take advantage of. As you move off the floor, you have to learn to look at very, very different cues. And so it's good to be back. Yeah, you can hear when the market is really kind of doing something special.
Do you think, and by the way, this is fun because we're kind of doing something special as well.
Yep.
You're a bit of a CBOE competitor in some products, but in the spirit of doing a program in a place where people are making markets, I thought this would be a fun conversation because some of what you're doing at Nations Indexes is trying to find other ways to assess volatility, basically.
We're trying to deconstruct skew because if the only thing you look at is VIX, and let's face it, the VIX is the 800-pound gorilla. It's the volatility index everybody knows about.
It's right over there.
And but if all you're looking at is VIX, then you don't know what's happening in, say, out of the money calls or out of the money puts or deep out of the money puts. It's all kind of mushed together into a single number. And so we deconstruct skew with our VolDex measure, which is purely at the money implied vol. Our CallDex measure, normalized price of 1 standard deviation out of the money calls. Put dex, important on a day like today, normalized price of 1 standard deviation out of the money puts, and then tail dex, which measures the likelihood of a crash based on what people are doing in the option business.
Now, here's what I guess if I were to kind of take a contrarian view on the need and the utility for kind of breaking apart a popular product. It's almost like a technical perspective where people say, oh, well, if everybody's looking at that, then it does matter. So if this thing's so big, if the gorilla's so heavy and people are using it, then does it keep its force in the market?
Oh, sure, absolutely. But that doesn't mean that smart traders can't know more than what VIX is telling them. And the way to do that is to deconstruct skew. I put it this way. If the only thing you look at is VIX, which again amalgamates just essentially every out-of-the-money option that's listed, and that's the only thing that you look at, that's a little bit like looking at the S&P 500 and seeing what it's doing on the day, but not being able to look through it and see what any of the individual names are doing. What's NVIDIA, what's Tesla doing. If all you can see is the headline S&P number, you don't know what those numbers are doing, and you're really at a disadvantage.
You talk about how you used to feel the pit and feel the noise and feel the market. Obviously, what you're building here is very, very data-centric. You have a partnership with SpiderRock, which is a Chicago-based entity as well. But I'm wondering, are these usable products and concepts for just kind of the everyday person? Where is that entry point where you're doing such size or you're trading markets in such a way that you really need to take that kind of under the hood look at vol and break it up?
Well, we don't actually think it's that much under the hood, because we focus on a few important elements or swaths of the option skew. But the important thing, and something we talk about in our Volatility Insights newsletter, weekly, free, everybody should sign up.
Nations Indexes.
Nationsindexes.com, and you can sign up for it there. Is what we say is that you pay attention, for example, when these indexes get to extremes. And on the website, we explain what the average is and what the extreme levels are. And for example, we had a great trade last month in AMD because CallDex was really high, very high, 76th percentile of its 52-week range, and the stock was overbought. So when calls are very high, and the stock is very high, that's a great time to sell a covered call. So we had a great covered call that people learned about from our indexes.
So much of this market right now seems to be about vol up, price up, vol up and price of underlying up. Whether it's the way people are scraping income off of very volatile products that are generally still going higher, if it's what you're talking about here on stock specifics, is that kind of the story of volatility and options today? Is that a beast that we're going to have to, that maybe we like right now? We're seeing these opportunities. Can it work against us?
I think one of the really interesting things is that about 10 years ago, we started to see systematic vol selling strategies, particularly in ETFs, whether they're selling covered calls or they're doing the JEPI product. They have driven implied volatility, that is the cost of options, down to a very fair level. And I think the next thing we're going to see is people taking advantage of that by systematically taking long positions, long volatility positions in options. And so I think that's actually going to be the next step. But for example, something that we talk about on our X account, for example, is you can get a tremendous amount of information if you look at what out of the money puts are doing versus out of the money calls. So our put dex measure versus our call dex measure. And you would think that if volatility was up, those would both be up. Everything would be up. Those diverge, and it has nothing to do with market direction. It's purely a measure of implied volatility.
Those diverge. Exploitable opportunities.
That's right.
Involved.
Those diverge on about 44% of all trading days.
Wow,
and that is exactly.
It's a pretty high divergence.
And we were really surprised when we did that analysis and saw that number. And that is something people can take advantage of.
Okay.